Great. Welcome, everyone. Thanks for joining us today. We're going to get started right on time. We're going to look at how beginning option traders can use one-touch automation. It's just not for beginners, as I like to point out. So we have a lot of more advanced traders using this too. But what we've done is we've simplified what would otherwise be complicated. So that's part of the wisdom behind doing what we've done here with our technology. We're going to look at professional strategies for any market condition. We use our color-coded automated indicator for risk and profit controls. We don't need to watch any charts or anything like that or be stuck to our screens all day. We've got a really great feature with these one-touch responsive trade alerts. We'll show you a demonstration on that. And we're going to look at some of these option strategies the professionals are using on a daily basis. And then beyond all the technology and strategies, we are real people. So we do offer our services in terms of coaching and our brokerage services. And before we really get started, let's look at that risk disclosure. Do take a moment to look at the screen. You can take a screenshot and read every word later if you would like. That's okay by us. And we will then get started. Keep in mind, past performance is no guarantee of future results. You should always be using risk capital when trading. Okay, a little bit about who we are. We are founded in 1997, registered introducing brokerage firm. We developed proprietary options trading technology along the way after having traded really tens of millions of futures and options contracts. And we're registered with the CFTC and a member of the NFA. We're located in California. And by the way, if you have questions along the way, go ahead, enter those, and I'll see if I can get to those throughout the presentation. If not, we'll have time at the end for FAQs and questions. And my name is Eric Gebhard. I have a BS in Business Administration from University of Southern California. I'm a co-founder of AltaVest, and I've had various securities and investment licenses over the years with investment companies, mutual funds, annuities, insurance, so forth. I have my Series 3 commodity futures license at the moment and my Series 65, which is what investment advisors have. Maybe you've seen us over the years. We've done lots of presentations and webinars and so forth. We used to do a lot of this material with in-person events, and then of course the pandemic changed things, and here we are now doing things online, which is actually fine, and we reach a lot of people worldwide that way. Actually, this was an event last summer in Miami, so that was a real big group there, about 1,000 people. I spoke at that event. That was really I guess you could say it was a great experience. I met quite a few people backstage as well. Ran into Peter Schiff for the second time at some of these events and conferences. If you don't know who he is, he's always talking about, well, basically a gold bull. We're going to talk a little bit about gold later on as well. But anyway, if you've seen us before, we'll probably have a few new things to talk about today that you haven't seen before. We get often quoted in the financial press. Here's something just from a week ago, talking about gold and oil, asking us our opinion. And so, yeah, we'd love to basically give our feedback. And before we jump in, let's kind of look at the bigger picture. Why would we even consider alternatives in your portfolio? And that basically means an alternative asset is anything other than beyond your traditional asset class, meaning like a bond or a stock index where you're just passively long all the time. So it says here it may improve diversification and lower portfolio risk. So what we're talking about are strategies for non-directional trading. So you see here a market kind of range bound, trading in a range. Of course, bull markets as well, or even bear markets, it doesn't matter. These strategies are flexible for any market condition, which is really a good thing because look at this, just in the first half of 2026, almost all of the NASDAQ 100 gains came from just 10 stocks. So it's a lot of concentration risk in those 10 stocks. And you saw what happened actually this week and just this last month with a lot of that unwinding. So if all you did was buy and then held on to the what they call that momentum basket or the high beta, basically the stocks that everyone owns. So you can see this huge sell-off we've had since then. So you want to try to avoid those drawdowns. That They call it the high beta momentum, down 37% for the month. This is as of yesterday. Uh, Worst monthly performance in history, worse than 2000, worse than 2009. So a lot of those Mag 7 stocks are part of that, but a lot of it is semiconductors and AI related. So everything that you would see on headlines and on business channels and CNBC, all the stuff they're talking about, that's what really is in this momentum basket. So you really can't hide in the Mag 7 stocks all the time and just expect it to always go up in your favor. Escalator up and taking the elevator down. But just more of the same here, talking about July was the worst month for momentum on record, excluding the COVID crash, which is right here. So in any case, we're going to talk about strategies for all market conditions, and then also we're going to have a little reveal here of a new way to trade, either long or short, the biggest tickers in the stock market using about 6 times capital efficiency. So some of the tickers here available, you can see Tesla, SpaceX, Pfizer, Qualcomm, Apple, Amazon, IBM, Oracle, J&J, all the big ones, Nvidia. So and we'll also a little bit of a attention here to crude oil and gold. But let's get into the options trading demonstration here, and we're going to get into the software in just a second. And before we do, I want you to think about the top 3 barriers that impact you when it comes to trading, and let me know if you can relate to these. How about just information overload? A lot of clickbait, headlines, price targets, opinions in the media, social media, friends, family, you name it. And this one here kind of made me laugh, so I put it in here. And how about tweets? So you get here's the guy trading up until recently, I suppose, looking at charts and looking at fundamentals and doing the research. And now here's how a lot of us are trading. So at least we shouldn't be, and a lot of people are. And that information overload gets in the way of our decision making process. You end up with this guy have his head there in his hands. You want to avoid that analysis paralysis. How do you even know what's important and what isn't when you have so much information to sort through? So like this guy here says, too much information. So let's avoid that if we can and use technology. And that's what we're going to talk about here. And then how about just time? You need time and discipline to screen watch. And some people do it successfully. It's a very, very small fraction of people. And mostly we have our lives to live and we can't enjoy a setup like this. But this is how people envision their trading setup. That's all good and well. But then here's kind of what it ends up doing here. You end up staring at a screen, watching trades all day and getting whipsawed and so forth. So we're going to avoid that as well. We don't do any screen watching. And for good reason. Here, only 5% of day traders are making money, according to a recent article here on MarketWatch just last month. If you have a really useful indicator or plan or process and it's working for you, and that's fine, not trying to uh, discourage people from doing that. But the reality is most people don't have a situation that's practical to be able to day trade or even trade on a short-term basis. So the third emotion here, our third barrier would be emotion, which is really just us. We get in the way of ourselves. When it comes to money, there's fear and greed involved. We get on this emotional roller coaster and you're doing well, making lots of money, and you think you're smart and you get euphoric. And then the market humbles us and we get filled with desperation and despondency. We raise that white flag of surrender. And then maybe things start to get better again. And then you're optimistic and you just go up and down on that roller coaster. So we need help. We need to control our emotions. We're going to use some technology and we're going to use professional automated option strategies to help us along the way. And before we jump into that, how about just a brief review of options? We'll just take a minute here. Keep it real simple. A put option just represents the right to sell a security or asset at a particular price before it expires. So just remember, a put option is an instrument that offers the right to sell something, and a call option is the opposite. It offers the right to buy something at a particular price before an expiration date. So you've got put options represent selling, call options represent buying. And you can be a buyer or a seller of an option, whether it's a put or a call. And if you're a buyer, you're said to be long the option. And if you buy something, you pay, of course. And this is called the premium that you pay. And who receives it? Well, you're paying the premium to the seller in order to buy a put or a call. So the seller is thus said to be short, and they're collecting the premium that the buyer pays. So it's really very simple. You can be on either side of that transaction, just a matter of placing the order to be a buyer or a seller. Uh, so just that simple. The buyer always pays the premium, and the seller always collects the premium, whether it's a put or a call. Here are long option strategies where you again pay a premium. It's also called a debit trade or a debit spread. It could be. And here's a bull market. The arrow's moving higher, and maybe someone might decide the market's going to keep going up, 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 and they might buy a call option or a call spread and they pay a premium. Or if they're in the bear market, the inverse is true. The market's going to be dropping. Hopefully, they might buy some put options at a particular strike price, say represented by this blue horizontal line. If the market keeps dropping and dropping and dropping before that option expires, that put option could increase in value, and whoever bought it could then sell it for more than what they paid for it. So those are long option strategies. You simply buy an option or put or a call, or you buy a spread, and that's the maximum risk on that position. And that's called a debit spread, where you pay the premium. Then the short option is really the opposite of what we just looked at. It's the person collecting the premium, and they're taking a credit. They're receiving a credit. They're not. It's not a debit position where they pay a premium. And again, you can have non-directional strategies where you are selling options above and below, where the market might be trading, collecting premium. In a bull market, you might sell out of the money puts and collect premium, hoping the market keeps going higher. Or in the bear market, you might sell out of the money calls or spreads. So we're going to look at something here in just a second, but two terms we're going to look at from the Greek alphabet, two Greek letters. Delta helps us determine probabilities. How much does the option value change with a change in the underlying index? It's also the approximate probability of expiring in the money. So that's how we look at delta as an options trader. And we'll look at some examples. If a delta is 0.20, that means there's a 20% chance that option expires in the money, and an 80% chance it would expire worthless. And remember, delta is always moving up and down, and it's not a static number, and it is not the probability of a winning trade. So don't make the mistake of thinking a delta is the probability of a particular winning position. And now there's theta, sensitivity to time. Remember, every option has limited life, so that's called time decay. So options are a decaying or a wasting asset with limited lifespan. So you refer to this time as theta. It's a negative number. It equals 1 day of time decay. And here's what it just looks like on a graph, quite simply. If you're approaching time zero, the value of the option, that premium drops and drops and drops in terms of its time value, especially in the last 30 days here. You see this red area. So that's just called theta decay. And we're going to see if we can use that to our advantage. So we can use delta and we can use theta in building option strategies. And we're going to look at strategies that large institutions and money managers and hedge funds are using. And why do they use them? And what are they? Well, they always involve typically selling options. And why is selling options better than just buying options? Well, here's a little piece here I picked up. They talk about professionalism. Selling options is a sophisticated discipline, requires a disciplined approach, and it's managing risk like a professional, avoiding common pitfalls. Professional approach distinguishes option sellers from novice speculators. And it's a preferred strategy for long-term investors who value consistency over high-risk speculation. So, a couple key elements there to option selling. And then AI here, I asked AI about selling options rather buying. They talk about the advantage of time decay. So remember, you sell an option to someone else, and that option is going to expire at some point. So you can use that theta decay or time decay to your advantage. It talks about the seller receives the premium up front that can equal a higher probability of profit. Talking about market neutrality, we looked at a couple quick little illustrations there on a non-directional or market neutral position. So sideways markets, there are strategies for that too. whether the market's just kind of chopping around, going sideways, doesn't have to go up or down. And then you can exploit the market inefficiencies. But really, it says here selling options is a preferred strategy for many professionals. And Wall Street professionals are trading option spreads. So they use theta decay to their advantage. So they collect premium from buyers to offset the cost. So let's look at an example of a spread. And it'll be, I think, more clear once we look at something on a graph. So here's a directional spread to collect premium. It's also called a credit spread. So you have the red line where you sell an out of the money put, and the blue line where you buy an out of the money put. So it's called an out of the money put spread, but you're selling it and you're collecting premium. And then as the market moves, in this case, a little higher to lower over time, you're able to then buy back that position for a lower price than what you originally received for it. So you've sold at a particular number, you sell. The idea is to sell high and buy low later before the trade expires. So that's just a simple example, and I'll explain what this RTI indicator is in the demonstration. But you can see when it turns blue, that's a profit taking signal. And this can be automated as well, and I'll show you how to do that. And then here's a non-directional strategy, something called a condor, but don't worry about the names and so forth. But see, if you notice here, it's the same type of trade on the puts. You sell a put spread, but you simultaneously sell an out of the money call spread. So you look for the market to stay within that range, essentially between those two red lines. And you can see in this case, the market chopped around, kind of drifted lower, went back up, and eventually you have a profit taking signal here with that RTI indicator, and you would just move on and go on to the next trade. And then here's a dragonfly. This is a six-legged spread. If you look back here, this is called a four-legged spread. So you have uh, a call here and a call here that you buy, and a put here that you sell, and a put here that you buy. So four different legs or strike prices to that trade. Now here's one with six different legs. It's called a dragonfly. It's a variation on a condor. It's a trade we created years back. And very similar theme to the condor, where you trade some calls and you trade some puts, but the net result is you collect premium on that transaction. And you look for the market to stay within that range between those two red lines essentially. You can see the same market movement here that we just saw in the condor, and then you get a signal here to close out the trade and buy it back and then move on to another position. So that's a dragonfly. And there are advantages to the dragonfly versus the condor. I'll point those out a little bit more and tell you why, but briefly, you see you own this call option here, that's the blue, and you own this put option here, and that's the blue here. And you notice they're closer to the money than the red lines representing the puts that you sold, and the red line here representing the calls that you sold. So these add a little bit of extra protection or insurance to that position. Makes it a little more risk averse and gives you more staying power sometimes. You do give up a little profit potential, but we'll explain that a little bit further. And then there are directional spreads. We just looked at a couple non-directional strategies, but if you're bullish or bearish, there are plenty of ways to structure a trade with options. Here's one called a bull hedge, or it's a combination trade. And really, quite simply put, if you're bullish, you might want to place a trade where you buy an out of the money call spread. So you pay, it's a debit spread, but to pay for that or finance it, you sell an out of the money put spread at the same time. So you collect money for selling this out of the money put spread. And oftentimes you can do this at an even money or even for a credit. So you're looking for the market in this case to move higher. And then, of course, the call spread that you bought and that you own would do well. And the put spread that you sold to someone else would do well for you as well. And of course, it went the wrong way, then you'd have to cover your risk and you end up probably taking a loss on the short put spread in terms of having to buy it back for a higher price than what you originally sold it for. But we'll get into that in just a second. And then you can be bearish as well. It doesn't really matter, bullish, bearish strategies for any condition. But this is just the opposite. So if you're bearish, think the market's going to drop, maybe you wanted to actually buy an out of the money put spread. That's a debit spread. So you pay money for that. But to pay for that, so you don't have to pay out of pocket, you sell an out of the money call spread and collect premium for doing that. And that pays for the put spread that you buy. So often, again, that can be done for a credit. So, but on the other hand, rookies are mostly doing stuff like this. This is a nice little interview. I've used it off and on for a few years, but I keep kind of going back to it. But talking about here, let's read this. Majority of small time traders are buying the most basic call and put options. They have a much lower probability of profit versus advanced strategies like option spreads. And then here's a quote. Everybody in the business knows that if you're only buying out of the money calls, then you're likely going to lose money over time. So keep that in mind, folks. You don't want to just rely on the same strategy over and over. It's not to say you can't buy calls or buy puts on occasion, but you might want to use spreads if you're going to do a debit trade, and we're going to show you how to do that. So we're going to look at these professional option strategies using technology. That's called Theta Trader. This is our platform that we've built. These are automatically generated option trades with our proprietary algorithm, creating what we call theta trades. And these are one-touch responsive trade alerts as well. That's all part of the Theta Trader technology. Bull, bear, flat market conditions, any strategy, very flexible. And then we use automation for risk and profit tracking with what we call the risk thermal indicator, or the RTI. So it's time for the demonstration here. Let me switch my screen. Give me just a second, everybody. Okay. It looks like we're good on my end. I think I switched screens here effectively. And so now you're looking at the dashboard for Theta Trader. Let me get my mouse over here. So we'll go ahead, and this is a demo account I use for these presentations. So the real Theta Trader platform looks similar, but a little bit different. Won't have everything up on the menu there, but you'll notice there's a section for trade alerts. Here's a section for Theta trades, your open, short, or sold positions. We talked about premium collection. So that's what these trades represent. And then open bought or long positions. Those are debit positions. And then this is your account information here. This is all integrated and pulled directly from your AltaVest trading account. So of course, AltaVest developed Theta Trader. So this is the technology our clients use. And then your current pricing there. So let me look at the Theta trades for the day. You can see there are bullish strategies. Remember, we talked about bullish strategies, various I could just say iterations and versions and approaches, different strategies depending on your outlook. There are bearish strategies here. These are all automatically generated and presented to you. And then there are non-directional or neutral strategies. And then we look at three primary markets: the E-mini, S&P 500, NASDAQ 100, and Russell 2000. And briefly, or to cut to the chase, the reason we trade these markets is because they're highly liquid and the strike prices are available, and they offer what we feel is the best execution. And I'll give you some details on that. But you'll notice that all of these here are available, these various directional or non-directional strategies. And the algorithm decides on any given day which markets are going to be available at what value and so forth. So let's look at a couple of examples here. Here's a Russell um, 2000. That's a mid cap, small cap index. And let me look at it right here. So you'll see there are dragonflies and there are condors. So we'll look at that here. And I'm just going to pull up an example of a condor and a dragonfly, and let's compare the two. I think I just pulled up one here. So yeah, here we go. So here is there are three condors available here on the Russell, anywhere from 33 to 63 days till expiration. And you can see the strike prices are all pre-selected for you. And then this is your maximum profit potential at expiration on any one of these trades. And this is your targeted annualized return. And this number here is used to compare one trade to another. And we'll go ahead and just look at the one with the longer days till expiration. So we'll look at the one that has 63 days till expiration, and this is a condor. And we'll look at a graph and kind of go through the table of details here. First thing I like to do is look at a chart. So this is the call spread you're selling, and this is the put spread you're selling, and you're doing this simultaneously. Here's the expiration date of this particular trade. That's the purple line. And we always plan to be out of a trade before it expires. So keep that in mind. So this is just a graphical depiction of what the trade looks like. Quite simple. And then if you want to go back to the details, you'll see here the expiration date, the settlement value, the premium being collected, put risk, call risk, commissions, capital required. Here's the cash required. Here's your profit potential, targeted return on cash, targeted annualized return. And let's look at this. Here's kind of the key. The algorithm says to sell the 25.25 strike price put, and that has a delta of 9.72. Now remember, that means this would offer a 90% plus probability that this put that you're selling to someone else is going to expire worthless and out of the money. So that's a higher probability outcome. That's why the algorithm in part chose it. And here's a call option that's being sold, 6.49% delta. So you've got over a 93% probability that the option, this call option that you're selling to someone else, is also going to expire out of the money. So just kind of looking at the math, and that's what the algorithm does, among looking at the proximity to the current market, looking at the days till expiration, theta decay, so on and so forth. So you'll notice here it defaults to a sell because you're selling the spread and you're collecting premium, and always defaults to a 1. If you want to change the quantities, you can. You changes your cash required and your profit potential. And I think people will sometimes scratch their heads at first, and it's not clear, why would you use $1,121 to try to make a maximum of $129? Well, again, it's the delta. This is the higher probability outcome on this position. And of course, these numbers are always changing. So there may be times where this profit potential is, maybe twice that great. It just depends on day by day. But anyhow, so we'll go ahead and we'll run this up from a quantity of 1. We'll go up to, let's say, 5. And you can see here your cash required, your maximum profit potential. And we'll leave the gross point number there at 3. You're trying to collect 3 points or higher on each particular spread. And then you just place the order. And then because it's a demo account, it just assumes that your order is filled. So that's how simple it is. Now let's look at a dragonfly. So here is a Russell Dragonfly, and we'll look at the same expiration, the September into month with 63 days. So remember, the trade we just did was a condor. Now here's a dragonfly, and you'll notice, I'll slow down just a second here and zoom in. Maybe this helps. So the structure here, you sell 4 calls, you buy 3 further out of the money, and then 1 closer to the money. So you're totally covered on this position. For every call that you've sold, you also have bought one or long. So these are completely covered positions. Same with the puts. So you're never naked. And you'll notice the call option here in this case is, closer to the money, obviously, than the 4 that you've sold. And the same thing with the put option here, the higher strike price put, closer to the money than the other 4 that you sold. So these act as additional hedge or additional protection or insurance if the market, say, starts to move higher and higher, moving closer and closer to the short calls here. The one that you bought here is got a higher delta, so it's going to gain in value more quickly than the 4 that you sold, and really sometimes act as a nice hedge and buffer against a trade like this actually losing. So sometimes the dragonfly will end up being a winning trade and a condor will not. So that's why we really like the dragonfly. It's a little more risk averse, but you'll see here cash required, your profit potential, and everything is net of fees and commissions, by the way. So all that's calculated into Theta Trader. But you can see here the puts that are being sold on this dragonfly have an 11.9 delta, and the calls being sold are a 10 delta. So you again got 88% and maybe a 90% probability that the put and the call that you're selling to someone else is going to expire worthless and out of the money. We'll go ahead and we'll do perhaps four of these just to be different. We'll try to collect 7.9 or higher. You could always change that if you wanted. And we'll just go ahead and place that order. And there it is, shows up as being filled. So that's how simple it is to take a trade right off the dashboard and place a non-directional strategy like a condor or a dragonfly, or of course you could be bearish or bullish as well. But we're not going to spend all that time going through everything else. But let me show you a couple of other things and how to compare. There is a great trade simulator here, and I want to show you how to compare condors to dragonflies, and also look at maybe a bullish position or a bearish position. And I've loaded, let's see here. Let me squeeze this down so we can see. That should work there. Okay, so here's a trade from May 1st. It's a iron condor on the E-mini S&P 500 for the June expiration. So this is what the trade setup looks like. You sell this out of the money call spread and put spread here, and you use these buttons to go forward in time or backward in time. So we're just kind of looking at um, what happened in the past. So it's kind of a time machine to see how these trades would have worked out. Or we can use this button. Now see here the green RTI, that means good. The yellow RTI just means a little bit of extra risk, but still do nothing. You can see the trade is losing money at the moment, and that's partly because there's no theta decay in terms of, or not enough theta decay has worked its magic yet, and also because it's starting to move uh, almost immediately higher out of the gate, and maybe putting pressure on the short call position there. And then it, kind of retreats a little bit, consolidates, gets a little choppy, going back from yellow to green to yellow. And this means do nothing. It's just giving you a little bit of notice that there's a slightly elevated risk, but still do nothing. The algorithm says stay in the trade. Still do nothing, stay in the trade, do nothing, do nothing. It turns green. So now the trade and the P&L is getting profitable, and now you get a profit-taking signal here with the blue RTI. And you'll notice here that if you didn't have an indicator to follow, you might have panicked and you might have closed out that position at the worst possible time. But the RTI didn't panic. It just said, sit tight and let the trade work, let the algorithm work, let the theta decay work. Then you ended up with a profit taking signal here with 7 days till expiration. So that's when you would close out that position. And I'm going to show you how to automate that. So that's the June iron condor. And I want to compare that to a dragonfly. So the same expiration, instead of a condor, we're doing a dragonfly. So you can see the RTI changing green to yellow, kind of similar. Obviously the same market movement here, just a different structure of the strategy. So the trade's losing money, no surprise. Then starts to become profitable, and then you get a profit taking signal here with 11 days till expiration. So you see the blue RTI on June 8, but with the condor, you had to wait till June 12 before you had a profit taking signal. So one of the benefits of a dragonfly is it can mature sometimes more quickly than a condor. And again, that's partly because you own this call option here in this particular case. So it's actually providing more benefit to you as the market's moving higher and higher in this case. You own it. So it's gaining value more rapidly versus in this case, the 77.25 call. And the structure on every trade can be different depending on I'm going to say structure. Like a dragonfly, it'll always look similar to this with the calls and the puts, but the distance between the strikes may sometimes differ. Like in this case, it's 25 points between this call and these calls here, but sometimes it can differ. It just depends on the setup. But so that's a big advantage with the dragonfly. At times it can mature more quickly versus a condor. And let's look at another condor versus dragonfly battle. So uh, this is a trade on the end of month May expiration, and we'll go ahead and see what happens here. Look at this. Market just ran straight up and it turned orange, even more risk, and then it finally turned red. And that's too much risk. Get out of the trade. You've got a loss and don't let it get any bigger. So here's a losing trade on a condor, and you end up taking a loss here if you're following the red RTI. So red means take a loss, and then blue means take a profit. And again, this can be automated, and I'll show you that in just a second. Now let's compare. Had you done a dragonfly on that same day instead of a condor, what would have been the result? Let's take a look. So you see the market movement doing the same thing, obviously, turning orange, even more elevated risk, but do nothing. And then it finally turns profitable. So again, this is a more robust position because you own this call here. And even though the market's really getting close to those that red line, those short calls, the one you bought here is providing some level of protection. It's not going to fully protect a trade from taking a loss. It just means it allows you sometimes to write out a position and allow theta decay to work for you. So it can be more robust because you own this call. Of course, if the market were dropping, same thing might happen because you own this put versus the four that you sold. So that's why we like the dragonfly. You can sometimes have a winner versus a condor, and also you can sometimes get out of a trade earlier versus a condor. And of course, a dragonfly, like any trade, can still take a loss, period, but it is more robust, but you do give up a little bit of profit potential. Then here's an example. Let me just run back here. We mentioned you can be bullish or bearish or what have you. And we have any of the standard types of strategies, but that one we mentioned in the slides about 10 minutes ago, 20 minutes ago, the bull hedge. Here's an example of maybe you're bullish and you can buy an out of the money call spread, but don't pay for it. Use another trade to pay for it. Sell an out of the money put spread at the same time. So take that credit you received from the put spread that you've sold to someone else and use it to buy an out of the money call spread. And you can often do that for a credit. And let's see what happens. You can see initially, the market's going down, so the trade's losing money, and it starts to rally again, and then you're getting profit taking signals here as it goes up, up, up. So, of course, this trade probably worked out real well if you hung on to it. So, in any case, that's how you do it. If it went the wrong way, then you'd have to cover your risk on the short put spread there. All right, let me show you now how to automate everything. It is right here. You go under my account, you go to your settings, and you'll check your activate risk manager box here. Let me pull this a little tighter there. Okay. And you can see you can use the default risk level of 0.50, which is how I have this set up, or you could modify it to 0.38, or you could use a custom level anywhere from 0.25 to 0.50. So what this means is if you go down to 0.25, you will have more frequent losing trades, but the magnitude of each loss will be smaller versus a risk level of 50. So if that suits you, that's fine. You can do that, or you could do something in between. I just leave it here as a default level at 0.5. And then you'll want to click Save Your Settings. And then same thing with the profit directive. If you check that box, it'll save those settings. And then the RTI will then, when it turns, in any case, the profit, when it turns blue, it'll automatically place that order for you and close out that position if the order, if the market fills the order. And then the same with the risk manager. Once you automate it, the orders are automatically placed for you. So Theta Trader scans your account and then monitors the position on your behalf. And then this is kind of a nice feature here. There's a nice help file. There's a lot to it, but You can see all of it here, but this is a color coding here, description of things. I'm not going to stop and read it all, and strategies here, all the details. So there's a great help file if you want to really dig into that. And also, you'll notice here there are videos on navigating the platform. Although what I showed you is really most of it. So it's very intuitive and user friendly. Placing trades. These are all just 2 and 3 minute videos. Here's an education section. I want to point this out. We call it our master class, but I did these actually not too long ago, within the last year, I think. And I made each chapter real short. So you don't have to go through 18 hours of education. There may be 10 minutes each. And it covers, stock index futures trading, options trading, advanced strategies, and so forth. So it's all part of the Theta Trader platform. So that's all very user friendly and available to you there. So again, you've got the help file we just looked at here. And then also I want to point out the research we have under the account menu. You go to TradeScope, and we have a newsletter we do each day. So give you a rundown on what's happening in the markets, and then our outlook, and maybe a hint at what's coming in terms of new trades. So that's a really nice little tidy package that people like to refer to. It takes them just 2 or 3 minutes probably to look at that each day. You don't have to go looking for information elsewhere. And let me go back to the dashboard and let me point out a couple key things. Let's see, where was it? Oh, yeah. If you want to look at your closed positions, you go here. So I just pulled them up here. And here's an example. There's 20 closed positions on each page, just the way it works. You can filter starting uh, any date range you want, any strategy you want. This is just covering all the strategies. And you can see there's 20 trades on the page. There's 19 winners and one loser. This is the total P&L on the closed trades. And you'll see short position, 16 winners and 0 losers, and then bought position, 3 winners and then 1 loser. Now, this is a good streak, and it only goes back to mid-May. So I'm just pointing out that this is what you'd have access to. If you're trading your own account, you'd see your trade history like this, and then you can go back and click on any one of these positions. I'll just click on a Dragonfly here, and you scroll down, see how it's highlighted in gray. Then you'll scroll down and you can see here the history of that trade. It was placed on June 19th. It had 57 days till expiration. You can see the RTI was green the whole way through. And then it finally had a profit taking order with 33 days till expiration. So you weren't in that trade very long. But there are times where you're going to have strings of losses in a demo account too. But the idea isn't that these are all winners. It's just the idea that also notice too, the one losing trade was a bought position. So that kind of makes sense. Your long positions or your bot positions don't have as much of a high probability of success. But when they do win, they may have a very large winner they may deliver a very large winner. So it's kind of an asymmetrical return in that case. But that's what I wanted to point out when you look at the closed positions. Now, let me go back to the dashboard. You'll see there are 2 trade alerts here. Here's one on the the S&P mini, and then here's one on crude oil. So this is really, really interesting. So you'll get trade alerts delivered to your dashboard, your email, and your phone. And you'll receive trade alerts based on what's already in your account or what's not in your account, and also based on how much capital is in your account. So the trade alerts that you receive are actually customized, and they're appropriate, and they fit your account in terms of the available balance, and also in terms of your concentration risk or any similar positions. You're not going to receive a trade alert if you already have, for example, a position that's the same as this or similar. And the quantity here you'll see is pre-sized. It's already selected for you, and it's all based on percentages in your account and how much capital you have and cash available and so forth. So you'll see in this case, this is just a demo alert for a Dragonfly spread into month expiration, has 63 days till expiration. These are the calls, these are the puts. Here's the current market price. And here's the expiration date, that vertical purple line. Now, if you want to change the quantity, you can, but you can't go higher. You can't increase your risk, but you can lower your exposure. Maybe in this case, for whatever reason, you want to do 9, you just change it and you'll see your premium collected change, your cash required change, and so forth. And of course, this is all customized to you and your account size. So in this case, I'll just take the default setting and we'll go ahead and accept that alert. And there you go. It just assumes you're filled because it's a demo account. Then you'll see here, there's another alert for a crude oil call option, another spread, and that's a debit spread. But remember, we talk about selling options. So instead of just buying a crude oil call, we're actually selling one as well to help pay for the one that we bought. So these are 120 calls you buy, and then 150 calls you sell. It won't totally cover the cost of the 120s, but it takes the edge off, so to speak. So that's a kind of a run through on the platform. But let me show you what I think is the best feature of all, if you bear with me as I switch screens. Okay, so we're back, and this is the actual trade alert functionality that comes to your phone. And this is what I think most people rely upon. The dashboard is great and getting an email is great, but what's more convenient than having a one-touch responsive alert coming right to your phone? So again, these alerts are integrated with your trading account. You just simply touch accept and the order is placed on your behalf. So that's what the technology can do. All you do is touch accept or reject. So here's an example. This is what it will look like. You'll receive a text message with a link, and you'll just click that link, and it will pull up the alert page. Should look somewhat familiar. Here's an alert for Dragonfly. So you get a description on that, 60 days till expiration. You see the calls here, you see the puts here. Again, you want the market to stay in that range between the red lines. This happens to be a quantity of 5. And you can change it again by lowering it. So you can't go higher. It won't let you go higher, but you can go lower. And it's telling you how much premium you're collecting, the cash required to maintain that trade. Then if you like the trade, you just touch accept and everything's handled for you. So how convenient is that? That makes very something very user friendly that would otherwise be kind of complicated to put these trades together. So that is a rundown of the Theta Trader platform along with the trade alert functionality. And so here's how you can get started with Theta Trader using the software, which includes everything we just saw, including all of the theta trades, which are the pre-generated option spreads, using the risk thermal indicator, that color coding for the automated risk and profit. Then you have that trade simulator. That's a great tool to go backwards in time using those buttons. So the software technology valued at over $3,500. And then there's that automation there with the RTI. And then it also includes your trade alerts. So I don't think you've ever seen trade alerts that work this easily and that are this intuitive and user friendly. You'll receive something to your phone. You can just touch accept or reject, and the technology handles the rest for you. So once your trade is filled, by the way, you'll notice that the RTI, which is going to turn either red or blue before expiration, it can then automatically manage that profit and loss for you on that trade. So making it very user friendly for you. Yearly value on all of that technology over $4,400 on that trade alert technology. So everything together valued at over $8,000 for the technology. But keep in mind, we are real people and we speak to people each day, just like yourself. And we coach people. That's part of what we do, part of the full service attention. You can share a screen with us and we'll walk you through, answer your questions. We're all licensed and experienced, having done this for decades. I asked AI about packages for private trading coaching. They're talking about a $5,000 to $15,000 package for a 6 to 12-month training. And what we're saying is with Theta Trader, that's all part of your package. So we think that's value. It's fair to say it. Let's just split the middle and say it's a $10,000 value. to have a co-pilot, a licensed trader to discuss your trading, review your trading, uh, lay out a roadmap for you. So everything we just talked about, the technology, the alerts, the private coaching valued at over $18,000. But I don't want you to forget, and this sounds a little corny, but those infomercials, there's more. We do have the daily research, the newsletter there. We looked at TradeScope. That's a really nice proprietary piece of work there that comes out every day for our client base, only available for Theta Trader users. And if you've never traded futures or futures options, we've still got you covered. We talked about our futures and options masterclass, those videos. That's all part of Theta Trader as well. Here's the chapters: futures, stock index futures, options review, futures options, advantages of stock index options spreads, and then advanced options spreads there as well. So everything you really need to know to kind of wrap your head around what's happening and how the Theta Trader is accomplishing what it is, what it's trying to do. So that education valued at almost $2,000. So that's all part of the package, the research and the education. And then, of course, those tutorials we mentioned, the videos, a lot of work and time goes into those, and makes it so simple that you can really just spend a few minutes going through a video and you'll be able to realize exactly how to operate a particular function on Theta Trader. So you have the software, the alerts, the training with the coaching, the education valued at over $21,000. That's our total package value. Of course, that's not what we offer it for. We can do a lot better. This is kind of the retail rate we used to offer at live seminars. So we'd have a live event and then people would sign up at the back of the room at this amount here. Here's the retail rate here. That's through the website, but we can do much better than that for you. So this is a lifetime membership. And this is a discount offer. We like doing this for live webinars. This is what we do during a live presentation. So a lifetime member, 3 payments of only $197, and you can use that QR code if you'd like. And you can go to the link cf.altavest.com/tt. So go ahead and take a screenshot of this page. That's my direct phone number. That's my email as well. Or here's another way you can go about it. If you don't want to make 3 payments, you can just pay by saving even more money with one payment of only $397. So you've got 2 ways to go about becoming a member. You can do one payment of $397 or 3 payments of $197. And we do limit this to the first 12 signups. And that's no joke because we're real people and we take time to speak with you once you sign up and onboard you. And we want to make sure everyone gets attention. So if you're interested, I'd encourage you to get signed up. And really, you have no excuse, and I'll show you why. Because for one thing, you can get a rebate on your membership. So if you fund your account with 100,000 or more, you get that 100% rebate. Or if you fund your account with 25,000 and above, you get a 50% rebate on your membership. So get started, get your account funded, and you get that rebate. And we also have a 30-day money back guarantee. So if you signed up today and in 29 days and 23 hours later, you decide it's not for me, uh, my life has changed somehow, whatever it might be, and you want a rebate on your membership fee, just let us know and we'll rebate that membership fee to you. So you have really no risk there. And how about some time for some FAQs? Why index futures options? Stock index, I should say. Well, looking at the E-minis, there are many advantages in the E-mini option space. Um, According to AI, lower cost and capital efficiency, defined risk, reduced volatility exposure, improved probability of profit, cost-effective directional and range strategies. So we kind of looked at that. Directional, bullish or bearish, or range-bound strategies. So capturing that theta decay, flexibility, and they talk about execution and liquidity. And then multi-leg combos use exchange multi-leg execution. So what I want to talk about real quickly here and show you what they're really referring to are being able to place spread orders efficiently. So if you're doing a dragonfly with us, that gets placed as one order at one price right here. So all six legs get placed as one order at one price. If you're going to trade securities, you can't do that dragonfly with one order at one price. I've tried it. I've tried multiple platforms. I've asked around. If you've seen it, let me know. But you're going to have to do this and break it up into two different trades, the leg in and leg out. And it's really a bit of a nightmare. So, big advantage in the E-minis is being able to do a trade like this at one order and one price. And that's because there's so much liquidity and volume. And that's really the key to this. And also, how about this advantage? You don't have to trade, or filter 6,000 different securities, and you've got just the handful of these markets that we're trading. CME Group gives some more reason to trade E-mini, S&P futures, deep pools of liquidity, average daily volume over 1.3 million contracts. And that's on the options they're talking about. Robust liquidity, deep and reliable liquidity, facilitating diverse trading strategies. So that's what we just talked about with the Dragonfly. And then margin is more capital efficient than securities. And I'm going to show you that in just a second. And look at this here. The E-mini futures trade $500 billion notional every day. That's 10 times more value traded across all S&P 500 ETFs. So this is where the activity is, folks, in these markets. If you didn't know it, you know now. And there's that wide margin of error with a lot of these strategies we talked about. You don't try to always have to pick a bullish or bearish direction. We looked at those non-directional strategies, the condors and the dragonflies. And of course, also, even if you're in a bull market, maybe you just want to sell some out of the money put spreads, or in a bear market, you just sell some out of the money call spreads. And even if the market in this case didn't keep going higher and it just went sideways, even dropped a little bit, uh, these out of the money put spreads should still do well for you. And same with the calls. So, again, here's an example. This wide margin of error between the short puts and the short calls, just kind of another graph there to. Sometimes it's even more than that. Sometimes it's less. It depends on other factors. Here's even more, 1,825 points on the S&P between the calls and the puts being sold. And then remember, long option spreads or debit spreads, they can be useful, and they do have limited risk. They offer that asymmetry, so the larger payouts, but they do have a lower probability of outcome. So long option strategies, you might even do a straddle where you buy a call and you buy a put, hoping you get a big move up or down, but that can be expensive. You might buy a call spread if you're bullish, that's fine, or you might buy a put spread, and that's fine too. But the thing is, you don't want to rely on those types of strategies. So another thing is no margin calls when trading with us. Every approach we take is only covered strategies, so no margin calls, no unlimited risk. You're not forced out of your positions. This is a good joke. She's asking who is margin and why does she keep calling you? So you won't get those calls. No margin calls from us if you're trading the way we trade with Data Trader. You also have tax efficiency with the futures options and the E-minis. So they are tax efficient according to the IRS. They're considered what they call 1256 contracts, so they're treated differently where 60% of the gains are taxed at the capital gains rate and 40% at your personal rate. So that can end up being a big, big difference at the end of the year for you every year. And then there's no itemizing, no wash sales or anything like that. You just get your P&L for the year, and that's all you have to worry about. Put in your profit in there and do your taxes. But always consult your tax attorney or advisor. And we do offer self-directed IRAs. So we work with Equity Trust. And I think we're going to do another presentation with them soon. We did one last year, and they've got 71 billion as of middle of last year under management. So essentially, if you want to do a self-directed IRA, we can do that. And we work with some of the best. They'll even waive your setup fee if you tell them you're with AltaVest. So as a reminder, we're a full service brokerage. So beyond the Theta Trader technology and the options technology we talked about, we can trade any commodity futures and futures options market. So futures and options, that's what we do. Gold, crude oil, copper, corn, you know, treasury bonds, the currencies, you name it. So we're going to speak just for a second here about a new product. Individual stocks are now available as futures contracts. Did you know that? So you can utilize over 6 times the capital efficiency versus individual stocks. And you want to know what I'm talking about? I think you probably do. These are called single stock futures. 50 plus of the top US stocks, and you can go short, you can go long, and they have capital and operational efficiency. So let's look at a couple examples. You trade with less upfront capital versus traditional stocks. Futures allow you to trade with margin, controlling a larger position. So here's an example: single stock futures, about 15% of the amount is what you need for margin versus a fully funded stock position. So here are some of the symbols you can trade. You've got AMD, Amgen, IBM, Intel, JPM, Caterpillar, Nvidia, Oracle, Tesla, SpaceX, Starbucks, Palantir, you know, Pfizer, Apple. So all the big names you're familiar with. So available now as futures contracts. So here's how it works as an example. Assume both investors have $20,000 of capital. Um, the fully funded investor invests all 20,000 upfront to buy 100 shares of Nvidia at $200 per share. So that's it. They use all their money to buy 100 shares of Nvidia. Or a single stock futures investor, you can purchase one single stock futures contract of Nvidia, and the margin is about $3,000, and that represents 100 shares of Nvidia. So much more efficient to trade in these particular single stock futures. And there's also micro available as well. So it represents 10 shares, not 100. So again, single stock futures, you've got 100 shares of underlying stock per contract, margin efficiency, and it's a really, really interesting new product. Just came out this month, and you can go long or short with ease. You don't have to borrow to go short. You just place the order to buy or sell with futures. That's all you have to do. No borrowing fees or anything, no borrowing stock, nothing like that. And briefly, here's a question: what's the best performing asset in the last 20 years? Anyone respond to that? I'd love to see a response. Any guesses, anyone? Let's see here. I see a question coming in. Thanks for the question. We'll try to get to those in a second. But the answer to this question here is, that should be a clue to the answer. Best performing asset in the last 20 years. It's actually gold. So you can see it here compared to the S&P, silver, the Russell, and even bonds. So hard to believe, but a lot of people overlook that fact. And gold has overtaken U.S. Treasuries as the central bank across the world, their top reserve asset. So you can see here. Here's some projections here for $10,000 gold by the end of the year. James Rickards, he's pretty good with this stuff, but making price targets is always difficult. And on the other hand, you got China buying the most gold since 2023. They're back into the market buying gold, and they're quietly stockpiling gold as their reserves rise. So as the price declined here in the last couple of months in gold, they've been buying more and more. But why has gold awakened? Well, currency debasement created a price inflation, and then government debt is surging. So here's our purchasing power of the US dollar since 1995, down over 50%. So if gold's priced in dollars, it has to move up in price. And then government debt, fiscal irresponsibility. You're talking here, the price of gold would need to surge to 26,000 to equal the 1980 high. So pretty interesting. Keep that in mind, I guess, is what we're saying. We think there's a structural bull market going on in gold, and it's not over yet. And looking at energy prices, who would have thought that after the initial run up in crude oil prices, they would sink like just about as quickly, even in the middle of this war and attacks on refineries every day and pipelines, and the 20% of the oil transfer world's, I guess you could say, shipping capabilities through the straits there in Hormuz is now restricted dramatically. So anyway, we're starting to move back up, but we think there's a lot more left, and I'll show you why. Strategic petroleum reserves here. We're down here now. We're estimating almost at our minimum operating level, and our reserves are shrinking, as you can see here. All these reserves, whether it's just crude oil or even the products, all hitting a brick wall at the same time. Inventories falling to multi-year lows. You can see here. There we are with the U.S. oil inventories. So anyway, something to keep in mind. And then these are all part of the alternatives universe. So all the strategies we looked at today, they don't rely on the stock market going straight up, or don't rely on traditional assets like bonds moving in your favor all the time. So that's why we like the flexible strategies. Bank of America talking about commodities dominating. They're moving away from the 60-40 portfolio, and they're moving into gold, copper, energy, and that traditional 60-40 portfolio of stocks and bonds looks to be outdated. Goldman Sachs, JP Morgan, Bank of America all recommending adding allocations to gold and commodities. And they're talking here about this red section here is when the 60-40 portfolio has failed, and you can see it fails a lot. So anyway, we think Theta Trader looks like a great alternative investment solution. Diversify, use automation, non-correlated strategies. You can speculate or even hedge your stock portfolio. Have a section of your investment dollars into the alternatives slice of the pie there. So that's a lot of information. I think we're finishing here just a little bit, about an hour, just about right. And if you have questions or comments, and let me know. Someone's asking about, let's see. Oops. Receiving a trade alert with the maximum number of contracts based on capital available. Yeah, you can adjust the quantities or the percentages. You can do that, and we can help you do that. Absolutely. And it's not really the maximum number of contracts based on available capital. If you had $20,000 of available capital, you're not receiving a trade that's going to require $20,000 of margin in an alert. You're going to receive a trade that's going to be maybe representing 5% of that or 10% of that in terms of the quantity. So we're always adding positions on an incremental basis and never getting fully loaded in any one position, if that helps answer the question. All right, let's see what else we have. Risk calculation on an iron condor trade example. Basically, the risk is the difference between the strikes minus the premium collected. So if you do a mini S&P iron condor that has, you calculate the difference in points between the strikes, and then that's the maximum risk minus your premium, because the maximum risk is only one side or the other. You're not going to lose on both sides of an iron condor. The market can only move one direction um, at once. So, but yeah, call us, ask us more specifically. We can walk you all through the details there. But yeah, those are some good questions too. And let me put let's see, let me put the link in there. Okay, so that is the link. And yes, we always get one of the similar questions about, if you're in Canada, give us a call and ask us where you are, or send me an email. Just depends where you're located in terms of being able to have an account with us. But other than that, let me know if there's anything else I can do for you. You've got my number, you got my email, you've got the link there to get yourself signed up, and we'd love to get you onboarded. You'll get your login credentials right away after we receive the notification that you signed up. We'll get those out to you soon to log in, and then you can start receiving trade alerts as they come out, and also using the platform in demo mode. You'll have access to that right away in demo mode, and we'll get the onboarding started with your account and so forth. You'll get an email with instructions on how to go about that. So, all right, everyone, that's going to wrap it up. I look forward to hearing from all of you, and we'll talk to you shortly. Bye bye.